Good evening, value investors, friends, family, people of YouTube. Today we're going to be going over exactly how we can understand Bitcoin's value and determine it using Metcalfe's law. So you're going to want to stick till the very end if you want to ultimately understand what price should Bitcoin actually be at in terms of its overall market capitalization and where is it at now. So we'll be able to come up with a model, and I'll show you guys exactly how I did this in Excel using this paper that's shown here. We'll come up with a model to determine where Bitcoin's price or market capitalization should actually be at, and then we'll be able to compare it to its current actual market capitalization and determine whether or not it's undervalued or overvalued. Now, because I believe very strongly in the value investing framework, I was so happy to find this paper here. So let me just make sure that we have good audio for tonight. Nice. Okay, we do have good audio for tonight, which is excellent. And I am going to start off with the article. Now, a little sneak peek into what I have coming for you guys. I'm going to show you how to set this up yourself using Excel and just a couple basic tools. You'll be able to come up with a model, a generalized Metcalfe's law model, and then also compare it to the actual market, and then you'll see whether or not the market capitalization of Bitcoin, and really this is applicable to any cryptocurrency, you'll be able to see whether it's overvalued or, in cases in 2014, 2015, 2016, whether it's undervalued. So we'll get to that in one moment, but first what I want to do is go through this article here. So are Bitcoin bubbles predictable? Combining a generalized Metcalfe's law and the long periodic power law singularity model. We won't be going over this last part so much, but the generalized Metcalfe's law part, that's what I'm going to dive in, because that's where most of the practical value is found, at least with respect to this article here. So the abstract, right, or the too long didn't read of the science world. We develop a strong diagnostic for bubbles and crashes in Bitcoin by analyzing the coincidence and its absence of fundamental and technical indicators. Using a generalized Metcalfe's law based on network properties, a fundamental value is quantified and shown to be heavily exceeded on at least 4 occasions by bubbles that grow and burst. And what do they mean by those 4 occasions? Well, there were 4 times in Bitcoin's history so far that have proven to have been pretty big bubbles. In these bubbles, we detect a universal, super exponential, unsustainable growth. We model this universal pattern with the long periodic power law singularity model, which parsimoniously captures diverse positive feedback phenomena such as herding and imitation. The LPPLS model is shown to provide an ex-ante warning of market instabilities, quantifying a high crash hazard and a probabilistic bracket of the crash time consistent with the actual corrections. Although, as always, the precise time and trigger, which straw breaks the camel's back, is exogenous and unpredictable. Looking forward, our analysis identifies a substantial but not unprecedented overvaluation in the price of Bitcoin. Keep in mind, this article was published in 2018 and accepted 2019, so right after that huge 20K bump up, and then followed by a correction, and now we all know where it's at now. But just understand the framework or the context in which this article was written, suggesting many months of volatile sideways Bitcoin prices ahead. So here's the reason why we're not going to be going into the LPPSL model, is because of this sentence right here. The precise time and trigger is exogenous and unpredictable. So these guys basically come up with a model to warn individuals. It's pretty elaborate and beautiful, if you ask me. But they even mention it here that even with the model, it's hard to predict exactly when there's going to be a breakout overvaluation or breakout bubble or breakout depression. So with that being said, there's still a lot of value to be had in this article, because one, we're able to model an intrinsic value for Bitcoin, specifically for Bitcoin, and two, because we have that intrinsic value, we're then able to compare it to the market capitalization, or what it's actually trading at, and then determine whether it's trading above or below its current value. So, you know, if you guys have been following the channel, I'm slowly fleshing away. I'm like a sculptor, fleshing away and sculpting out something useful when it comes to finding an intrinsic value model, some principles, right? Some first principles that we can work from so that we can rationally invest in cryptocurrencies. Super happy to have found this article. I spent the entire day reading and just working on the model that I showed you guys in Excel. So the introduction. In 2008, pseudonymous Satoshi Nakamoto introduced the digital decentralized cryptocurrency Bitcoin and the innovative blockchain technology that underlies its peer-to-peer global payment network. Since its techno-libertarian beginnings, which envisioned Bitcoin as an alternative to the central banking system, Bitcoin has experienced super exponential growth. Fueled by the rise of Bitcoin, a myriad of other cryptocurrencies have erupted into the mainstream with a range of highly disruptive use cases foreseen. Cryptocurrencies have become an emerging asset class, and a rather unique one at that, as shown by the evidence in the research. At the end of 2017, the price of Bitcoin peaked at almost 20,000, and the combined market capitalization of cryptocurrencies reached around 800 billion United States dollars. Let's skip through some of this part here. Let's see if there's, here we go. So let's start at number 2. So the fundamental value of Bitcoin, active users, and generalized Metcalfe's law. Now it is foundationally agreed upon in the literature. While we can't measure exactly how many people are participating, in other words, how many people have purchased Bitcoin and exchanged Bitcoin and hold Bitcoin, we can't determine that. We can use a proxy to determine that, and that proxy measure is number of active addresses. The good thing about using the number of active addresses as a proxy for the amount of users in the system, in Bitcoin's ecosystem, participants, in other words, users, a good thing about that is that it's free. It's free and it's downloadable online and available to anyone who wants to use that information to their benefit, people like me and you. So, Metcalfe's law is basically users squared, right? So the value of any one network, this is typically used in the sense, well, academically it's been mostly used in the sense of describing the value of a telephone network, right? If there's just one person that has a telephone, then the network is useless. The value, in other words, is 0. According to Metcalfe's law, it's the number of users squared. If there's only one user, well, 1 times 1 is 1, so that's basically useless. But as the amount of users increase, right, so does the value of the network proportional to the square of its users. So this is exactly what this is saying here. Now, in this paper, they make a slight derivation or a slight change to Metcalfe's law, which is completely fine. They add this constant here, and it's Euler's number to the alpha of 0, and this is useful for the mathematics later down the road. But I would definitely say that I agree with this. This constant was added ad hoc to help the model fit better, right? And Euler's number is just 2.718281828459045, which is a number that comes up naturally in many scenarios. It's quite baffling and a beautiful number. But beyond that, I don't think there's too much to worry about this slight change here. In fact, I agree with it very much. It helped me out, at least, retrofitting a model for the users. So here they go on to show that you can take the active addresses on the Bitcoin network, square it essentially, and then plot it on a logarithmic scale, and you can actually see, as compared to the market capitalization going back from 2011, so the market capitalization are the dots here, and then the red and the black and the yellow that you see, these are all just market capitalization plots, and the y-axis here is the Bitcoin market capitalization, such that its growth over time has been exponential, sometimes super exponential, right? And then the number of active users. So you can see this, the solid red line is their slight derivation, or what they refer to as the generalized Metcalfe law model that they developed. The raw Metcalfe law, so in other words just the active addresses squared, is this dashed line here. And you'll notice that the dashed line, it fits, but not as good as the solid line. That slight change that they made to Metcalfe's law was really helpful in fitting in fitting the data. Now, if you guys know anything about retrofitting lines to minimize the square differences between the dots and the actual line itself, you'll know that there are some violations when it comes to this line and the dots, right? The dots, or in other words, the market capitalizations, while it fits on an average case, right? If you look at the actual behavior, the phenomenon of the data points themselves, they vary pretty wildly. And they mention this in the paper, right? They go on to say, it should be noted that this regression severely violates the assumption that the errors be independent and identically distributed, as there are persistent deviations from the regression line. And then this is the kicker, is that this statement deserves to be made in more salient terms. The residuals are in fact the bubbles and the crashes, right? This is the focus of the second part of the paper, ignoring the egregious violation of the so-called Gauss-Markov conditions, right, is well known to give a false impression of precise parameter estimates. Further endogeneity is an issue, but ultimately the hook, line, and sinker here is that this solid line, as predicted by the number of users in Bitcoin's network, is what the market value should be, and then the market value are these dots. And you'll notice that the dots here, right above the line, are when the market is overvalued, and when the dots are beneath the line, when the market value data points are beneath the predicted line, then that means they're undervalued. So if you are a strategic investor or a value investor, then it would have been in your best interest to invest from years approximately 2014 through 2016, avoid 2017 through 2019 just about, and then purchase right before this 2018 super dip or super increase. And now this paper is a little old, but there is a, you'll see it in a moment. I'll show you guys the graph using this exact same model, except extended out to include literally up to yesterday's data point for market capitalization. I feel I've never, you know, if you look at the data, we've never seen such a large increase. I mean, this is on a logarithmic scale, and yet it almost looks logarithmic itself. It looks exponential, rather. It's in the market, according to this research, if the research and the logic extends, the market as it stands now for Bitcoin is incredibly overvalued. The market capitalization is much larger than what we would expect following Metcalfe's law. So they just go on to explain a bit further as to their model. And something I want to show you guys before we get into the Excel, and I'll show you guys exactly how to set it up at home. You'll see that they were able to document the red, the green, and the blue, and this baby blue here are moments of what they refer to as hyper exponential growth. And overvaluing of the market capitalization of Bitcoin. And they were and this is something that I found absolutely beautiful, is that if you're interested in value investing, you know, we're always looking for shorthands and for ratios to help us know whether or not a stock, for example, is overvalued or undervalued. Excuse me. It says here, bubbles in the market to Metcalfe ratio. Given our proposed fundamental value of Bitcoin, based on the generalized Metcalfe regressions presented above, we define a market to Metcalfe value, or an MMV ratio, such that the P of I, P sub I here, is the market capitalization of Bitcoin, and then this denominator here, the e to the negative third power, or rather the product of e to the negative third power and u squared, well, this is just Euler's number, so it's 1 divided by Euler's number to the cubed root, multiplied by the number of active addresses, right? It's our proxy for users, squared. So this product in the denominator, and then in the numerator here, the market capitalization yields a market to Metcalfe, or what they refer to as a market to Metcalfe ratio. And this is helpful. Why? Because then we can now understand when the market capitalization and the and our Metcalfe Metcalfe calculation are in agreement, then it should yield a number 1, right? So that's a case of equilibrium. If the ratio is beneath 1, right, if it's a fraction of 1, then that would be a case where the market, the Bitcoin market, is currently undervalued, and that would be a time to strike. I would even argue that just the way the market has grown historically, and in the current circumstance of hypergrowth that the overall cryptocurrency market is in, even values close to 1, albeit above 1, are cases where perhaps it would be wise to invest. However, as that ratio begins to approach 10, that's when you see cases of bubbles that have popped, right? So the popping, of course, is the after effect, this gray line here. So it looks like the researchers, and I also agree with this, use 10 as a top limit to say that, okay, the bubble is about to burst, because every time it has hit 10, afterwards the bubble bursts, and then you see this regression to the mean. And there was a YouTuber who I really like, who was talking about this. He uploaded this video, I think, yesterday. I think his name is Tom the Investor, Investing with Tom. He was talking about regression to the mean rather, and I really liked it, because you see this phenomenon happen frequently, where there are derivations from the norm, but then they always regress right back to what they should be. So with that being said, let's dive into the Excel and let's talk about that. And I'll show you guys exactly what I did. Let me just make sure we're looking good. Okay. So for for calculating Metcalfe's law, so let's start off here. So you have to first get the active addresses downloaded along with the date. So once you put that in, then what the researchers suggest is that you smooth out this data. So this is an arithmetically valid way of analyzing, or coming to a Metcalfe, coming to some conclusions about the market capitalization of Bitcoin. So what you would do is you would take these values here, and then you would go to data and then data analysis. And there's actually a tool for this. You would go, where is it? Here it is. You would click exponential smoothing, and then once you hit OK, it's going to ask you for your input range. You would select this range here. The damping factor, that's up to you, but I chose as close to 1 as possible. Well, as close to 1 as possible would have been 0.99, but I chose 0.95 because it looked like it smoothed it the most without losing too much information. Then you would select your output range, and I'm not going to do it because I've done it already, but then you would have something like this. And the researchers mentioned the specific reason we do this is to avoid some interactions between the market capitalization deviations on a day-to-day basis, because there are some influences, some backwards influences, when addresses increase rather dramatically, like how they went from 959 here to 213. So we would want to smooth that out for our model so that it doesn't, so that we could actually capture some differences in our graph. Then next you would simply download or copy and paste your market capitalization in your Excel sheet. And then the next thing you want to do is copy this formula. So the formula that I have here is Euler's number raised to the negative 2 power times the actual smooth users squared. So the reason we would do that is, well, if you'll notice that if I change this figure, let's say to 3, then it changes the graph somewhat dramatically. Let's drop this down. And then you'll see, so I don't really have as good as of a fit as with 2. Now you would play around with this yourself. It might be some time since I've downloaded, or uploaded rather, the this sheet. So the rules would change as they changed for the people who did the research. They changed for me, and this is simply a retrofit. It's not going to change the integrity of our analysis in any meaningful way. So once you've done that, then you're going to want to calculate your market to Metcalfe ratio, which is just as simple. You're taking your market capitalization and you're dividing it by your what I refer to as Metcalfe users. and then that'll give you your output here. This would be important for us in a moment. But once you've done that, then you can now graph and take a look at the generalized Metcalfe's law versus the actual market capitalization. And you'll see from periods 2014 through right before that big 20K bump for Bitcoin, the market was largely undervalued as determined by the number of users, right? So we would have expected the market capitalization, because the network gains value from the users participating in it, we would have expected it to be a bit here, but it looks like it was undervalued by several hundreds of thousands of dollars. And then the reverse is true at the current time. So you can see here that the market capitalization of Bitcoin is incredibly, it's much higher than what we would expect. Another thing to notice is that the number of active addresses is slowly, it's dampening in its rate of increase. Now keep in mind that this is a logarithmic scale, so any increase in the y direction still is a pretty sizable increase in an arithmetic sense. Nonetheless, there still is this dampening. So let's take a look, just for to be comprehensive. I wanted to make sure that this model that was built had some explanatory power, so I did a regression analysis, and the r-squared that was yielded was 0.65, or excuse me, an adjusted r-squared was 0.65, with a significant p-value for this independent variable here. So we're assuming that these Metcalfe users explain the variation in market capitalization. Another thing to consider would be the actual correlation itself, right? So is this array correlated with this array? And it is so, to the tune of approximately 81%. This is what this multiple r is. So we would want to make sure that they are related to some extent. Now the market to Metcalfe ratio, right? Because the thing that I think about when I see the market to Metcalfe ratio is, okay, so how would I use this in an investing sense? Keeping in mind that you can generalize this to other cryptocurrencies. So, you know, I see 3s, I see 2.5s, I see 2s and 1s, and I did a descriptive, I used the data analysis tool pack, and I did descriptive statistics to take a look at what the ratios look like for the past 10 years or so. And it looks like the median is 1.4, so 50% of the time it'll be higher than 1.4, 50% of the time it'll be lower, with a standard deviation of 2.01 and a sample variance of 4. It looks like there is some skewness. There's a range as well, pretty large range, with a minimum of 0.17, which means that, you know, if it's beneath 1, then the market is undervalued and we should strike. If it's above 1, right, in this case the maximum of this data array is 22 point, you know, some change. That's incredibly high and incredibly overvalued, and you would not want to put your money into a market with a market to Metcalfe ratio of 22.2. So let's see, are we missing anything? No, it looks like we're solid here. So this would be the practical takeaway for this. I have some work to do in the sense that I was taking a look at Ethereum's figures as well, and it looks like it also fits. I got a correlation of 86%, and it'll probably yield the same results. Granted, I was using the simplified Metcalfe's law as shown here, but perhaps it would fit a little better if I did some derivation of Metcalfe's law. But that's all I have for you guys. I hope you have a great rest of your evening. Take care. Remember to subscribe so you can continue to gain insight on how to analyze business performance, so that way your investment performance is optimized. Remember, when your investment performance is optimized, so is your wealth production. And before I go, I see Victor left a comment. I do want to address it. Hello, Victor. Good evening. What do you think about Ethereum short term? That's a great question. And instead of me telling you my opinion, Victor, what I would say is what the research says. So I've been reading what the research says about short term. And in the short term, well, first let's define short term. It would be anywhere from tomorrow through maybe the next 8 weeks, right? I would say 2 months is a good time horizon to define short term. They say that the short-term price for any cryptocurrency, Ethereum included, and especially Ethereum, um, a way to determine that would be to look at market sentiment. So quite literally, individuals on Reddit, right, what they refer to as the silent minority, what is the opinion among the silent minority? You could then determine Bitcoin's near future price. In other words, the price of Ethereum or Bitcoin tomorrow or in the near future to some degree of certainty from that basis. Another way that you could try to value Ethereum, in Victor's case, in the short term, would be to use, what is it? What do they call it? Time series momentum. So Victor, I don't know if you know any, you probably do know quite a bit about finance. Look up time series momentum, and from what I understand, it's basically looking at, in this case it's Ethereum, looking at Ethereum's past 12 months. This is just one case of a calculation. If the past 12 months have yielded a positive return, then there is evidence to believe that the next 8 weeks, let's say, there will be a positive return for Ethereum. Now, you might be thinking, well, what about a combination of both? I don't know if you have any skills in machine learning, Victor, but there are folks who combine both the results of time series momentum as well as the market sentiment analysis, scraping tweets, and they combine those two results and try to come to some determination, some very specific determination on the price of Ethereum in the future. So I would say, if you wanted to press me, Victor, on an answer, I would say that Ethereum in the short term will most likely continue to follow Bitcoin's lead. So if Bitcoin goes down, Ethereum will continue to go down. But we have seen Bitcoin's dominance slipping. So how long will that phenomenon hold up? I'm not too sure. Excuse me, but I would definitely say that if you want a very specific answer, and I'm assuming what you mean when you say, what do I think about Ethereum short term? I would assume you mean price. If you want to know a more exact figure for Ethereum price, I would definitely look into time series momentum and market sentiment analysis. That should yield some good results for you. But have a beautiful rest of your night, folks. I'm going to take off, and I'll see you guys tomorrow. Peace out.